Welcome back to the Wall Street Podcast.
Today, we're digging into the latest U.S. labor market report. This is from the Wall Street Journal's weekend edition, September 6th, 7th, 2025, and really looking at what it means for the American economy overall. The big question we're tackling is this. Is the economic deceleration we're seeing a healthy, sort of expected rebalancing, or does it point to something more worrying, like a widespread economic slowdown? I'll be making the case for a necessary market rebalancing.
And I'll be arguing that the data we have actually points to, well, deeper economic concerns.
You see, the recent moderation in U.S. job growth, especially when you couple it with the Federal Reserve's anticipated rate cuts, it really suggests more of a measured rebalancing than, say, an outright downturn. We're still seeing resilient sectors like healthcare and social assistance continue to add quite substantial numbers of jobs, nearly 47,000 new roles, in fact. And even in tech, innovation seems pretty robust. Look at that significant deal, OpenAI's, $10 billion custom chip agreement with Broadcom. To me, this looks more like a dynamic shift, not really a collapse.
I guess I come at it from a slightly different perspective. That August jobs report showing only 22,000 new non-farm payrolls, and I think crucially, the revised figures showing a net loss of 13,000 jobs in June, that's the first decline since December 2020, well, that signals a genuine slowdown to me. And it isn't just one sector acting in isolation. U.S. manufacturing lost 12,000 jobs, construction lost 7,000, and professional and business services, they shed 17,000. I mean, these are pretty broad-based declines, and they seem to point towards underlying structural issues, maybe even exacerbated by policy choices.
Right.
Those June figures, with the U.S. economy actually losing jobs for the first time in years, they are quite alarming. And it's not just the headline numbers either. Think about the rise in unemployment for specific groups. For younger workers, aged 20 to 24, unemployment climbed to 9.2%. And long-term unemployment hit 25.7%. That's the highest it's been since February 2022. So this really suggests a more, let's say, systemic weakening in the labor market. How do you square these widespread declines and this rising long-term joblessness with a healthy rebalancing?
Okay, that's a powerful point about potential structural weakness, but I would perhaps frame it a bit differently. While, yes, certain sectors and demographics are definitely facing challenges, the overall U.S. unemployment rate has actually remained broadly steady. And those robust job gains you mentioned, almost 47,000, they do demonstrate a clear shift in demand, not a universal drop-off. What's more, the overwhelming market expectation of a Federal Reserve rate cut this month, there's even a 12% chance priced in for a half percentage point cut. Well, that indicates the central bank is ready. They're poised to proactively support the U.S. economy through this transition. They don't seem to be behind the curve here.
And, looking beyond just those labor statistics for a moment, the broader market itself shows some compelling resilience. Think about the additions to the S&P 500, Robinhood markets, AppLevin, MCore. This isn't merely a list of names. It's a signal, right? A signal of investor confidence and maybe a pivot towards growth-oriented sectors. We're also seeing some signs of a consumer rebound, with Macy's reporting its first same-store sales growth since 2022, and even the upcoming expiration of federal EV incentives on September 30th has apparently fueled a bit of a U.S. buying binge, showing some consumer adaptability. So there are these clear pockets of growth and successful adaptations happening across the U.S. economy.
I'm sorry, but I find it hard to believe that those particular bright spots genuinely reflect the broader economic reality for most Americans. These positive market signals seem overshadowed by pretty significant headwinds. Constellation Brands, for example, a major U.S. beverage importer, just slashed its outlook citing widespread consumer weakness. That's a direct signal about household spending, isn't it? And on top of that, tariffs continue to inflict really significant costs on U.S. businesses. Caterpillar estimates, a $1.8 billion hit? And Ford is facing $2 billion in tariff costs just this year. This kind of uncertainty, this additional burden, it has to be contributing directly to the U.S. labor market's pullback and the tepid demand we're seeing. despite those isolated pockets you mentioned.
Right. Well, both perspectives certainly highlight the complexity of the current U.S. economic picture. I still lean towards observing a dynamic U.S. market adapting to new realities, with monetary policy seemingly ready to support stability and ongoing innovation. These structural shifts, while definitely challenging for some, also reveal areas of pretty robust growth and future opportunity.
That's a fair summary of your view, but I have to reiterate that the data, for me, points more towards a broad-based slowdown. The persistent headwinds from policy-induced costs and that widespread consumer caution, well, they simply can't be overlooked. Understanding the nuanced data and how these forces interact is really crucial, I think, for U.S. investors and the public as the nation sort of navigates its economic path forward.
Today's content ends here. Thank you for engaging with the debate.